Hello there, this is Tejas from Trendline. In this video, we'll be talking about the changing dynamic of the big growth markets in the pharma industry, particularly the US and Indian pharma markets. Lately, pharma companies have been shifting their focus to the Indian domestic market. We will discuss why exactly these companies are changing their strategies. We'll also look at top formulation companies' expected growth in different markets and analyze which growth formulator is expected to come out ahead. Top formulation companies in focus are Sun Pharmaceutical Industries, Cipla, Dr. Reddy's Laboratories, Torrent Pharmaceuticals, Zydus Lifesciences, which was previously known as Cadila Healthcare, and Alkem Labs. Sun Pharma is by far the largest drug company in terms of market capitalization with a value of around 2.3 lakh crore. If you look at the 10-year share price CAGR of these companies, Torrent Pharma, which was listed in 1994, leads the pack with a 24% 10-year CAGR. Pharma companies have been rising over the past month despite the overall market volatility, outperforming the benchmark index. Zydus Life rose the most in the past month as it received US FDA approvals for 4 of its key drugs. Sun Pharma and Cipla's share price rose both over the past quarter and the past month. Investors are reassessing the pharma sector as companies have been actively changing their strategy. Drug makers are shifting their focus away from the US generic space and towards the domestic market, as well as complex generics and specialty products in the US. While Cipla has a One India strategy to direct its focus towards India, Sun Pharma is focusing both on Indian market and on its specialty product portfolio in the US. Torrent Pharma has been acquiring private drug makers in India to expand its footprint in different segments of the industry. So let's briefly get an overview of what exactly is happening in these markets, which is prompting a change in strategy. Let's start with the US generics market. This was for a long time the money maker for pharma companies, especially in India. It is the biggest pharma market in the world at $128 billion. It is 6 times the value of Indian pharma market or IPM. FY11 to FY15 was a boom period for domestic pharma companies as they exported low-cost generic drugs to the US. A generic drug works in the same way and provides the same clinical benefit as a brand name medicine but is cheaper. Top drug formulators' revenue from the generic segment rose around 30% every year from FY11 to FY15. This exceptional rise was not sustainable as competition started to emerge. In addition, with stringent US FDA inspections, delayed drug and manufacturing plant approvals, revenue growth became more and more difficult. US FDA warning letters and manufacturing plant inspection on Indian pharma companies rose sharply since 2014. To accommodate the regulatory requirements, research and development spending, which is the primary cost of US business, rose. This, coupled with delayed product launches, meant that the EBITDA margin from the US generics business fell sharply from 25% in FY14 to 19.2% in FY22. Also, top companies' revenue from the generic segment turned negative in FY18 and in FY22 it fell by 1%. Despite this, why are the drug makers still trying to hold on to the US pharma market amid intense competition? Well, from CY22 to CY26, drugs worth $141 billion are expected to go off patent. This is a huge market that companies can't turn away from. To combat the price erosion and steep competition in the US market, several drug companies are also focusing on specialty products and complex generic space where the competition is relatively lower. However, there are hurdles here as well. According to industry experts, drugs in these segments on average are delayed by about 2 years, which significantly impacts the expected profitability. With all these roadblocks, drug formulators are focusing on the domestic market. Let's understand the reason why. Indian pharma markets are a relatively safe bet. We can understand this from its historical growth. The Indian pharma market or IPM has been on a constant rise since 2008. Over FY08 to FY22, IPM has increased at a CAGR of 11% and is expected to rise by the same CAGR over the next 5 years. Top drug formulators usually tend to outpace the IPM growth historically. Hence, the Indian market offers clear revenue visibility as opposed to ups and downs of the US pharma market. The growing middle class, insurance coverage, production-linked incentive schemes, and higher demand for wellness are expected to drive IPM. The domestic business mainly consists of branded drugs that are prescribed by physicians. Medical representatives play a major role in pitching drugs to doctors. In fact, medical reps costs are the main expense in the Indian market. This is because of less stringent regulatory requirements that lead to significantly lower R&D costs. As a result, the EBITDA margins are higher at 25% to 35% in Indian business against 15% in the US market. Major factors that affect the IPM growth are volume, price, and new product launches. Among these, volume is the most important growth driver. Price and new product growth have touched negative values, but volume grew consistently above 3%. So, Indian drug formulators mainly bank on volume growth. Coming to the price component, there are two regulatory hurdles regarding this. The National Pharmaceutical Pricing Authority sets ceiling prices for several essential drugs. The drugs in this list are known as the National List of Essential Medicines or NLEMs. Every year in April, these ceiling prices are revised in line with the changes in the Wholesale Price Index (WPI) to factor in an underlying inflation on a year-on-year basis. With regard to non-NLEM products, Indian pharma companies are allowed to increase the prices of drugs up to 10% every year. If you look at the top drug makers, we can see that Alkem Labs, Cipla, and Zydus Lifesciences have the highest exposure to NLEM drugs. But it is important to note that the regulatory authority changes the NLEM list every year and the company's exposure changes in reaction. However, more than the price growth, India is a volume driven market and there is no regulatory cap on volumes. Apart from these two markets, emerging markets also offer revenue growth along the same lines as the domestic market. But currency risks and country specific risks make these markets less lucrative. Now let's move on to the growth potential for top formulation companies in both the US and the Indian pharma markets, starting with India. High demand for drugs over the past 2 years pushed up the CAGR of India business, and as a result, all pharma companies in focus are expected to post lower CAGR over FY22 to 25. Barring Zydus Lifesciences, which has underperformed the Indian market in 6 out of the last 8 years, others are expected to post a double-digit CAGR, mainly driven by the chronic segment. If we look at the past and expected US business revenue growth for individual companies, we can quickly see that the projected growth is quite different from that of Indian business revenues. None of the top drug makers are expected to grow in double digits over FY22 to 25 due to steep competition and delayed product launches. In fact, Zydus revenue from the US is expected to rise only marginally as it lacks meaningful product launches. If we look at the geographical revenue contribution, Alkem Labs, Torrent Pharma, and Cipla derive over 45% of the total revenue from the India business. Companies with higher revenue contribution from the domestic market are expected to perform better than their peers. With Zydus Lifesciences expected to see lower revenue growth compared to peers. However, Sun Pharma has specialized in the specialty segment in the US and thus has a clear revenue growth visibility in the US markets as well. Now that we have looked at various factors that are affecting the growth of these pharma companies, let's summarize these in a table. Sun Pharma clearly stands out in terms of expected revenue growth both in India and the US and is expected to outperform its peers. Then comes Cipla, which has good revenue growth projected in both markets. Torrent Pharma and Alkem Labs are expected to post strong revenue growth in India businesses. This bodes well for these companies as they derive over half of their revenue from the domestic market. Moving on to Dr. Reddy's, though its India business is expected to grow in double digits, it only derives about 20% of its revenue from the domestic market, and as a result, its overall growth is pulled down by the US business. Finally, Alkem Labs has a strong foothold in the domestic market, where it derives around 70% of its revenue. However, its US business revenue is projected to grow marginally at 2.8%. From the summary, we can see that Sun Pharma and Cipla are expected to lead the sector in terms of revenue growth. Let's now see how the companies are valued in the market by analyzing the company's PE ratios. PE ratios are mostly in line with the expected growth of top drug formulators. Torrent Pharma and Sun Pharma lead in this metric, with their PE ratios higher than their 3-year and 5-year historical averages and also the sector average PE of 40. In fact, both these companies are classified as expensive stars according to Trendlyne's DVM classification. Zydus and Dr. Reddy's PE ratio is lower than the sector PE ratio and historical averages. This could be because of the low revenue growth visibility expected by the analysts going forward. Cipla's PE ratio is higher than its historical averages but is still lower than the sector PE. This is despite having strong growth visibility in its India and US business. Hence, there is a lot of headroom for Cipla's share price to grow. Even Alkem Labs has a lower PE ratio than that of the sector, but US revenue growth is projected to be relatively lower. All top drug formulators are expected to post revenue growth in FY23 despite a high base in FY22. Among these companies, Sun Pharma is expected to outperform its peers with strong year-on-year growth both in Q2 FY23 and in FY23. Barring Dr. Reddy's, other companies are projected to grow year-on-year in Q2. Zydus and Dr. Reddy's are expected to underperform the market in the next quarter and the next year as well. So in this video, we looked at how the Indian pharma industry has shifted their strategy over the past few years. We also looked at growth projections overall and the fundamentals and valuation aspects of top formulation companies and their increased focus on the domestic markets as it has a high revenue growth and margin visibility. You can find more information about these companies and any listed company on trendlyne.com. This is Tejas signing off.